Precious metals still climbing today with concerns about geopolitics and trade. Have a look here. Gold, spot gold at 46.36. That is a new record high. It's up 37.50 or 0.8%. Silver also marking a new high. It's at 93.08, so up $6.75, up over 7.8% today. Oil also a gainer on the day. So let's look at how investors can benefit from the broadening out of the market that's been going on. Thomas Martin joins us now. He's Senior Portfolio Manager at GLOBALT Investments. Thanks for joining us today.
Great. Thanks for having me on your program.
Are you bullish for 2026?
Well, the short answer is yes.
Okay. The longer answer?
Sorry?
The longer answer?
The longer answer is that I think, like everyone else, we're a little bit nervous and think that things are going to be a little bit jumpy here, and we've seen that a choppy year, midterm elections and the seasonals and whatever, and the market being still near all-time highs and valuations where they are. But we think that's offset by earnings growth, which is expected to be in the 15% range. And like you said, a broadening out of that earnings growth throughout the year as the quarters progress. And by the time we get to the end of the year, there will be a lot of companies that are growing and sectors that are growing their earnings greater than 10%.
Okay, so let's get to the 15% number that you had for earnings. Where is that coming from? What sectors do you see most benefiting, and from what are they benefiting from?
Well, for the most part, it's the same ones as last year. Information technology is the one that is benefiting the most, certainly in the fourth quarter that's being reported now. Financials also, although you really couldn't tell from today, the market hasn't liked their earnings reports, but the growth is there. And as that broadens out, you're going to see it in materials and industrials as we go throughout the year.
Okay, investors pulled money away from tech. They seem to still be doing that with that rotation happening. Should they say invested in tech, but just be pickier about the tech they're investing in?
Well, I think that we're just seeing a little bit of nervousness here and some movement that is not necessarily related to the longer term fundamentals. The companies that had been growing earnings are still going to grow their earnings fairly well. Even the Mag 7, which is underperformed, is going to have some good earnings growth. It does make sense, I think, to look for companies in any sector that have a little bit cheaper valuations that haven't run as much. But what we're seeing, at least today and so far this year, is more of a movement just broadly away from technology and even remaining away from software, which hasn't performed well and does have some decent growth characteristics. Into other sectors like staples, which doesn't really have much growth, and utilities, which is doing better, and healthcare, which won't see earnings growth start to kind of reaccelerate until later on this year.
Okay, so what does that tell you that this rotation continues? Is that sort of the nervousness you're speaking to?
Yeah, I think it is nervousness, and maybe some of that has to do with the macro environment and with some uncertainty with regard to policy at the Washington level. This idea of intervention in companies and industries, state capitalism, et cetera, whether it's capping interest rates that credit cards can charge, or, going after swipe fees, or, having Fannie Mae and Freddie Mac buy mortgages, et cetera, et cetera. There's a lot of balls in the air on a macro basis that I think have people wondering, what's going to happen kind of near term until those things start to become clearer.
Okay, so how are you advising investors right now? As you mentioned, the macro picture is constantly changing, and there are big, big moves, right? It's not like a comment here and a comment there. The American president talking about taking Greenland. He's looking at striking Iran. Venezuela just happened. So how are you advising investors? What are they asking you about?
Well, we actually haven't gotten much questions about the exact things that you're mentioning, with the exception of Venezuela, I think, because that is actually did happen and has an immediate impact on oil. I think what you're seeing in the markets is this movement to grab real assets in some form or fashion. Things, whether it's rare earths or other manufacturing materials that you need for critical equipment, but gold and silver through the central banks, and to sort of have something that you can hold on to, as opposed to financial assets, which really have been bid up over the last few years. So I think that those have been some safer places, but the rallies in those prices of the things that I mentioned, rare earths, gold, and silver, have been very, very dramatic. And so although we've had significant exposure to gold and silver, we've been paring that back, but it continues to go up. When those asset classes and those assets are doing well, it speaks to the uncertainty in the world, and it's not necessarily a good thing that people are flocking to that rather than, basic blocking and tackling companies.
Let's talk about the outlook for the Federal Reserve in the U.S. Retail numbers out in the U.S., inflation numbers coming out as well. Does any of that change your forecast for rate cuts?
Well, we really weren't expecting much in the way of rate cuts this year anyway. And, the dot plot's calling for one. The markets were calling for a couple by June. We thought that had a lower likelihood of happening. The economy has proven to be quite resilient. Labor is has weakened, but it's not bad. Inflation is still an issue to be reckoned with. It's not alarming, but it's not coming down to the levels that we want to see. With regard to the Fed's independence, that's something that we'll have to see. But I think that the markets know that at base, the Fed as an institution and most, if not all, of the governors know how important that is, and they've been messaging that. And the reason why we think it's not that much of a true worry is the rate on the 10-year has come down, and the odds of a rate cut in January, which were already very low, and in June for the rest of the year, have moderated from here. So the economy is doing well, and no real need to raise rates, and you do have to care about inflation.
Thomas Martin, I'm going to leave it there, but thank you for your time. Appreciate it.
Great. Thank you. Good to be on the show.